You've probably never heard this brutal truth from a trading guru, so listen carefully. Wanting 60% a month is exactly why you'll never see 60% a month. That single number, 60%, sounds exciting, powerful, almost heroic. It whispers to your ego, you're different. You're smart enough, fast enough to pull this off. But in trading, what sounds heroic is usually suicidal. The market has a way of punishing ambition dressed up as strategy. Amateurs obsess over monthly percentage targets. Professionals obsess over decades of survival. That's the fundamental divide. One group wants to get rich fast. The other quietly refuses to die. One group asks, how can I hit my number this month? The other asks, how do I make sure I'm still in the game 10 years from now? Think about your last ambitious goal. Maybe it was triple this account in 90 days, or turn $5,000 into $50,000 by summer. You didn't write that goal because it was realistic. You wrote it because it felt good. It fed your identity as the outlier, the prodigy, the exception to every rule. Walk through what usually happens next. You start the month disciplined. You take a clean setup at a pivotal point. You risk small, maybe 2% of your account. It works. You're up 3%. Another quality trade, another win. Now you're up 7%. For a brief moment, you feel like a professional. Then you look at your target, 60%. Suddenly, 7% doesn't feel like progress. It feels like failure in slow motion. You start doing the math in your head. I'm up 7%. To hit 60%, I need another 53%. There are only 3 weeks left. That's almost 18% per week. I'm behind. Right there in that mental calculation, your account's fate is sealed. You stop seeing charts. You start seeing a countdown timer. You stop thinking in terms of risk management. You start thinking in terms of what you have to make. You begin trading not what the tape is giving you, but what your goal is demanding from you. So you do what every amateur does when they smell speed. You increase position size, telling yourself, I'm trading well. I can size up. You abandon patience because setups aren't forming fast enough to meet your daily quota. You move your stop loss just this once to give the trade more room. And when it goes against you, you hold. Because you can't afford to take a loss and still hit 60% this month. That's not bad luck. That's mathematics plus human psychology doing exactly what they're designed to do when you introduce unrealistic speed demands. Here's the hidden truth. A 60% monthly goal is actually a leverage demand in disguise. Whether you admit it or not, you're telling the market, I'm willing to risk far too much, far too often, on setups I barely understand. Let's examine the math. To generate 60% monthly returns while risking a responsible 2% per trade, you would need 30 perfect trades with a 100% win rate. Nobody finds 30 perfect setups in 30 days. Nobody. So what happens? You start bending your rules. That stock sitting just below resistance, the one that hasn't confirmed the breakout yet, you take it anyway because you need the percentage points. That position down 3% when your stop was at 2%, you hold it, hoping for a reversal, because taking the loss puts you further behind your monthly target. Every decision becomes contaminated by the gap between where you are and where you think you should be. Professionals think differently. They don't start from how much can I make. They start from how much can I afford to be wrong and still be trading next year. That question changes everything. It shifts focus from offense to defense, from hunting returns to protecting capital, from monthly sprints to decade-long marathons. Jesse Livermore lived this paradox in real time across 4 complete boom-bust cycles. He had the skill to read the tape better than almost anyone in his era. When Livermore was patient, waiting for confirmed breakouts at pivotal points, sizing positions conservatively, pyramiding only after the market proved him right, he accumulated millions. Every fortune he built came slowly, through patience and proper position sizing. But his bankruptcies, those came from speed, from pressing too hard, from trying to force one more fast move with oversized positions when he felt he had to make money quickly. Same man. Same brain. Same tape reading ability. Different speed. Different outcome. The pattern repeated 4 times in his life. 4 fortunes built through discipline. 4 fortunes destroyed through impatience. The difference wasn't his understanding of market psychology or his technical skills. The difference was always speed. how fast he wanted the money, and how much he was willing to risk to get it quickly. Consider this mathematical reality. The trader chasing 60% monthly usually blows up within 12 months. I've watched it happen dozens of times. Here's how it unfolds. Month 1, he gets lucky, catches a momentum stock, banks 40%. He's thrilled, he's convinced he's cracked the code. Month 2, he pushes harder, risks more, maybe gets another 30%. Now he's certain this is sustainable. By month 3 or 4, the inevitable happens. A position goes against him. But he can't take the loss because it would ruin his monthly number. So he holds. And holds. He watches a 3% loss become 15%, then 30%, then 50%. One bad trade, held too long because of a monthly target, wipes out 3 months of gains. Now contrast this with a different approach, the trader targeting 5% monthly with strict risk control. It sounds boring. It sounds too slow. But here's what actually happens. Because her target is achievable, she doesn't feel pressure to trade every day. She can wait for quality setups at confirmed pivotal points. She can be selective. She can let bad setups pass without feeling like she's falling behind. The mathematics work in her favor. 5% monthly, compounded consistently, yields approximately 80% annually. But here's the crucial part. She won't hit 5% every month. Some months she'll make 8%. Some months she'll lose 2%. The average trends toward 5% because she's not forcing trades. She's waiting for the market to come to her instead of chasing it desperately. After 3 years of this approach, her $10,000 account has grown to roughly $32,000, over 200% total return, without ever needing to hit 60% in a single month. Meanwhile, the speed chaser has typically blown up multiple accounts and is either out of the game or starting over with borrowed money. Here's your first maxim. Slow is fast. Fast is fatal. This isn't motivational rhetoric. This is survival mathematics. A 60% monthly target demands that you risk approximately 15–20% of your account per trade, or take far too many marginal trades, or both. Those risk parameters guarantee eventual ruin. You might survive 3 months, 6 months, maybe even 9. But the market will eventually hand you a series of losses, and when it does, you won't have enough capital left to recover. But this trap goes deeper than just excessive risk. The 60% monthly goal rewires your brain. It changes how you perceive the market itself. A trader with a 60% monthly target doesn't see the same chart as a trader with a 5% monthly target. They literally perceive different opportunities, different risks, different urgencies. The amateur with the aggressive target looks at a stock consolidating below resistance and sees opportunity slipping away. The professional with the modest target looks at the same chart and sees unconfirmed setup, wait for breakout. Same price action, different perception, different decision, different result. This perceptual shift happens gradually. You don't wake up one morning suddenly reckless. It's a slow erosion of discipline, justified one small compromise at a time. Just this once, I'll enter before confirmation. Just this trade, I'll risk 4% instead of 2%. Just today, I'll ignore my stop loss and give it more room. Each compromise seems reasonable in isolation. Each one moves you closer to catastrophe. And here's the cruelest part. Sometimes these rule violations work. You enter early and catch the move. You risk extra and bank a big winner. You ignore your stop and the position recovers. These occasional successes don't save you, they doom you. They teach your brain that breaking rules produces rewards. They reinforce the very behaviors that will eventually destroy your account. You become like a gambler who remembers every jackpot but forgets every loss. The moment you attach your self-worth to a monthly percentage, the market owns you. You're no longer trading setups, you're trading your emotions. You're no longer managing risk, you're managing hope and fear. You stop looking at price action and volume. You only look at your account balance, thinking, I need $2,000 more to hit my goal. That thought is the beginning of the end. The moment you trade for the money rather than for the setup, you've handed your edge to the house. You must understand that real speed in trading isn't making money fast. It's compounding money without interruption. If you make 50% in January and lose 40% in February, you haven't made progress. You've just churned your emotions and paid commissions. If you make 4% in January and 4% in February and keep that streak alive, the geometric growth over a decade will stagger you. This requires a level of humility most people don't possess. It requires admitting you cannot force the market to pay you a salary on your schedule. It requires surrendering your timeline and accepting the market's timeline. When you make this identity shift, from someone who needs to be seen as a trading genius to someone content to be boringly profitable, everything changes. Your position sizing becomes conservative. Your stop-loss discipline becomes absolute. Your patience becomes your greatest weapon. Your emotional swings flatten because you're not riding the monthly percentage roller coaster anymore. The amateur secretly wants to post screenshots of massive monthly gains. The professional wants statements she can live off 10 years from now. The amateur brags about percentage gains in a single month. The professional cares about maximum drawdown and risk of ruin over decades. One question reveals who you are today. Do you feel bored by the idea of 3-5% monthly returns? If that sounds too small, ask yourself why. Is it because the mathematics don't work? Or because your ego can't stand the idea of not being special? You're not just choosing a target. You're choosing the kind of trader you're becoming. But this isn't just about lowering targets to make yourself feel better. In the next chapter, I'll show you exactly how the 60% goal rewires your brain on a neurological level, turning you from a disciplined trader into a desperate gambler, without you even noticing it's happening. You'll see the specific psychological mechanisms at work, the predictable stages of mental deterioration, and why this trap is so difficult to escape once you're caught in it. Because understanding the enemy is the first step to defeating it. Your brain wasn't designed for trading. It evolved over hundreds of thousands of years to solve problems your ancestors faced on the African savanna. Grab food when you see it, because you don't know when the next meal arrives. Flee from predators instantly without deliberation. React to threats with maximum speed and minimum thinking. These survival patterns kept your genetic line alive long enough to produce you. The stock market exploits every single one of these ancient patterns every single day. When you set a 60% monthly target, something insidious happens deep inside your neurology that you don't see at first. Your brain stops seeing quality setups on the tape. It starts seeing opportunities everywhere, because you need them to hit your number. This isn't a metaphor. This is literal perceptual distortion caused by goal-induced stress. Think of a starving hunter walking through a forest. He doesn't see trees, flowers, or the beauty of the landscape. He sees only potential food. A rustling leaf becomes a rabbit. A shadow becomes a deer. Every sound might be his next meal. He shoots at everything that moves because his hunger demands it, wasting arrows on phantoms, while real game slips away unnoticed. This is exactly what happens to your trading mind when you operate under the pressure of a massive monthly goal. You become the starving hunter. Every green candle looks like a breakout. Every dip looks like a support bounce. You lose the ability to distinguish between a high-probability setup and random market noise because your brain is filtering everything through the lens of desperate need. Your visual cortex begins processing information differently under this pressure. Confirmation bias intensifies. You notice every stock gapping up, but somehow miss the ones gapping down. You see breakouts forming everywhere, but ignore the failed breakouts littering the charts from last week. Your brain becomes a heat-seeking missile locked onto anything that might move your percentage meter, and it filters out everything else. Here's the neurological reality. When you set aggressive, difficult goals, your anterior cingulate cortex, responsible for goal-directed behavior, activates more strongly. When it activates intensely, it suppresses your prefrontal cortex, which handles rational decision-making and impulse control. Translation: the harder your goal, the dumber your decisions become. The 60% monthly target literally makes you stupider by hijacking your brain's executive function. Watch this psychological trap unfold in real time. You're 3 days into the month, you've taken 2 careful trades, managed risk perfectly, and you're up 2%. In any rational world, this is excellent performance. Annualized, that's over 200% returns. But you're not operating in a rational world, you're operating in the world created by your 60% goal. Only 2%? Your brain whispers, I should be at 10% by now if I want to hit 60% this month. The month is 10% gone. and I'm already falling behind. This sensation of falling behind triggers a physiological stress response. Cortisol floods your system. Your patience evaporates. You stop seeing cash as a position and start seeing it as wasted potential. You convince yourself that waiting is losing because waiting doesn't move your percentage meter. That's the first crack in your discipline, and once it appears, the fracture spreads with terrifying speed. So you increase position size. Not because the next setup is higher quality, not because your edge has improved. You increase size because you're behind on an imaginary schedule that exists only in your head. You tighten your time horizon, dropping from daily charts to 5-minute charts to 1-minute charts, because smaller time frames show more action, more potential trades, more ways to feel like you're doing something productive. Your stop-loss discipline erodes next. You set a stop at 2% below your entry, the position drops to 2.5%, and instead of exiting, you think, if I take this loss, I'm down to 0.5% for the month. I can't afford that. So you hold. You give it a little more room. You tell yourself you're being patient, but you're actually being desperate. Real patience is waiting for the right setup. False patience is holding a wrong position, because you can't afford to be wrong. Here's a real scenario that shows how fast this unravels. Marcus built his account from $10,000 to $18,000 over 4 patient months. That's 80% returns through disciplined execution. He did everything right. Small position sizes, strict stop losses. He waited for confirmed breakouts at pivotal points. He cut losses fast and let winners run. For 16 weeks, he was a professional trader in training. Then March arrived, and he set a new goal, 60% for the month. He wanted to prove to himself he could accelerate. The goal felt ambitious, but achievable. After all, he'd already proven he could make money consistently. On March 3rd, he saw a momentum stock rocket 15% in 30 minutes. The chart looked parabolic. Volume was exploding. His social media feed filled with traders posting screenshots of massive intraday gains. His 60% monthly goal amplified every stimulus into a siren call. This is it. This is the opportunity leaving without you. Marcus looked at his account, $18,000. He looked at his month-to-date performance, up $200, barely 1%. He looked at the calendar, 27 trading days, left to make $10,800. His brain did the desperate math. I need $400 per day. This move could give me 3 days of progress in 3 minutes. In that moment, Marcus didn't see risk. He saw rescue. He abandoned 4 months of careful position sizing in one decision. He went all in. No stop loss, because he couldn't afford to be stopped out. Full conviction, because he needed the home run. He told himself he was being aggressive on a high-probability setup. Actually, he was gambling because his monthly target demanded it. By 10:30 a.m., the stock was up 18%. Marcus was up $3,240. He was a genius. He'd found the shortcut. For 90 minutes, his 60% monthly goal seemed not just possible, but inevitable. His brain flooded with dopamine, confirming every rationalization he'd made. By noon, the stock reversed 12%. There was negative news, profit-taking, algorithmic selling. Marcus was still up 6% on the position, but momentum had shifted. A professional would have taken partial profits. Marcus held, because taking $1,080 wouldn't move him meaningfully closer to his monthly goal. He needed the full move. By 2 p.m., the stock was down 8% from his entry. He was losing $1,440. A professional would have exited immediately. Marcus held, because taking a $4,140 loss on day 3 would make his 60% target mathematically impossible. So he convinced himself it was just a healthy pullback. By close, the stock had reversed 20% from its high. Marcus exited at $12,000. One trade, one moment of speed, $6,000 of hard-earned progress erased in 6 hours. 4 months of disciplined growth destroyed by 6 hours of goal-induced desperation. Now consider the professional trader watching that same move. She saw the 15% spike in 30 minutes. She felt the pull, the FOMO, the fear of missing out. But she's conditioned herself to operate from abundance, not scarcity. She knows that missing one rocket ship means nothing if she preserves capital for the 10 confirmed setups coming next month. She asked herself the professional's question: is this a confirmed breakout from a pivotal point with proper volume, or is this a parabolic spike that could reverse any second? The chart showed parabolic extension, not sustainable momentum. So she watched. She learned. She took notes on the pattern. She preserved her capital. Same move, same information, different brain state, different decision, different outcome. When you need only 4 or 5% monthly, you don't chase. You can't afford to chase because you don't need to chase. The target is achievable through 3 or 4 quality setups executed with discipline. You wait. You let bad setups reveal themselves as bad without costing you money. Your brain can relax because the target is achievable through patience, not aggression. This relaxation isn't weakness, it's strategic advantage. A relaxed brain sees more clearly. It notices divergences between price and volume. It spots false breakouts before entering. It recognizes when it's about to make an emotional decision and stops. A stressed brain sees what it needs to see. It manufactures conviction where none exists. It interprets ambiguous signals as confirmation. It mistakes hope for analysis. The difference comes down to the primary question you ask yourself every morning. Amateur question: how many trades do I need to hit 60%? This question forces your brain into hunting mode. It forces you to find reasons to say yes to marginal setups. It lowers your filter. It makes you vulnerable to every head fake and trap the market sets. Professional question: how many bad trades can I survive this month? This question forces your brain into defensive mode. It forces you to find reasons to say no to questionable setups. It raises your shield. It makes you suspicious, careful, and selective. One mindset is hunting for treasure. The other is defending a fortress. You might think defending is passive, but it's actually the most aggressive thing you can do for your long-term wealth. When you defend your capital, you ensure that when the perfect high-probability setup arrives, the one that aligns with every rule in your playbook, you have both the mental capital and financial capital to strike hard. The 60% goal steals this from you. It forces you to deploy your resources into meaningless skirmishes, leaving you weak and exposed when the real opportunity arrives. Every time you look at your monthly goal and feel that twinge of anxiety, realize that your biology is trying to sabotage your bank account. That anxiety isn't a sign that you should trade more. It's a warning siren screaming that you're about to make a mistake. You cannot discipline your way out of this neurological hijacking. You cannot try harder to stay rational when your brain's executive function is compromised. The only solution is to remove the trigger. Change the goal. Lower the target. Give your prefrontal cortex room to function. When Marcus blew up his account, he wasn't defeated by the market. The market just moved. It went up, it went down. It didn't know Marcus existed. He was defeated by his own neurology, weaponized by an arbitrary goal he set for himself. You have to manually override this programming. You have to tell yourself, I do not care about the monthly result. I care about the process of this next trade. You have to detach from the outcome and fall in love with the execution. In Chapter 3, we'll replace this psychological hijacking with something your brain can actually trust: concrete math. We'll examine the exact risk protocol that makes modest monthly targets inevitable while keeping your survival instincts calm. We'll move from the vague anxiety of hoping to make money to the cold, hard certainty of managing risk. Because when you stop trying to hit a home run every time you step to the plate, you realize that hitting singles and doubles consistently is the only way to win the championship. Let's replace fantasy with arithmetic. You don't need 60% monthly to build wealth. You need repeatable returns and controlled risk. That sentence contradicts everything the trading industry sells you, but the mathematics don't lie. The market responds to only one thing over time: how you manage risk when you're wrong, and how you press your advantage when you're right. Consider 2 traders starting with identical $10,000 accounts on January 1st. Both understand technical analysis. Both can read volume and price action. The only difference is their mathematical philosophy toward risk and reward. Trader A is the sprinter. He targets 60% monthly returns because he wants financial freedom by year end. To generate those returns, he risks approximately 15% of his account per trade. His logic seems bulletproof: if I risk more, I can make more. Let's follow his actual performance month by month. Start with $10,000. Month 1 up 45%, account now $14,500. He feels invincible. Month 2 down 25%, account drops to $10,875. The drawdown stings, but he tells himself it's just volatility. Month 3 up 70%, account rockets to $18,487. He's convinced he's cracked the code. Month 4 down 40%, account falls to $11,092. The psychological pressure builds. Month 5 up 30%, account climbs to $14,420. Month 6 down 60%, account crashes to $5,768. Stop right there. That 60% loss isn't just painful, it's mathematically devastating. To recover from a 60% drawdown, he needs a 150% gain just to reach break-even. Month 7 up 20%, account reaches $6,922. Month 8 down 80%, account destroyed at $1,384. 8 months. Multiple emotional roller coasters. He peaked at nearly $18,500, but ends with less than $1,400. He's not just financially damaged, he's psychologically shattered. He has proof he can be right big, but his account is too small to matter anymore. Now examine Trader B, the grinder. She doesn't chase monthly percentage targets. She has a process. She risks exactly 2% per trade, never more. She waits for confirmed setups at pivotal points. Her year looks boring by comparison. January up 4%, February up 6%, March down 1%, April up 5%, May up 7%, June up 3%, July up 8%, August up 2%, September up 4%, October up 5%, November up 3%, December up 6%. Let's calculate her actual results. Starting with $10,000, month 1 brings her to $10,400. Month 2, $11,024. Month 3, $10,914. Month 4, $11,459. Month 5, $12,262. Month 6, $12,630. Month 7, $13,641. Month 8, $13,914. Month 9, $14,471. Month 10, $15,195. Month 11, $15,651. Month 12, $16,590. Her average monthly return is approximately 4.2%. After 12 months, her account has grown 66% without ever targeting or achieving 60% in a single month. But here's where compounding becomes magical. If she maintains this 4% monthly average for 3 years, her $10,000 becomes approximately $38,600, a 286% total return. The sprinter is usually broke by month 8. The grinder builds generational wealth through patience. Here's the protocol that makes this inevitable. These aren't suggestions, they're survival mathematics. Risk management framework. Rule 1. Never risk more than 2% of your equity per trade. If you have a $10,000 account, your maximum loss is $200, period. This single rule ensures you can survive 20 consecutive losing trades and still retain 67% of your capital. The sprinter risking 15% per trade dies after 6 losses. Rule 2. Maximum 6% total portfolio risk. 3 positions at full 2% risk, maximum. This protects you from correlated moves where multiple positions fail simultaneously. Even if everything goes wrong at once, you lose less than 2 weeks of solid gains. Rule 3. Monthly drawdown limit of 10%. Hit this threshold, you reduce size or stop trading entirely. This prevents bad months from becoming career-ending months. You don't revenge trade. You don't try to make it back. You preserve capital and wait for next month. Position sizing formula. This is where amateurs guess and professionals calculate. The formula is precise. Position size tick. Entry price stop loss. Account size 02. Here's a concrete example. You have a $20,000 account. Your 2% risk limit is $400. You want to buy a stock at $50. Technical analysis shows your stop loss at $47, a $3 per share risk. Position size equals $400 divided by $3, which is approximately 133 shares. Not 500 shares because you're confident. Not 1,000 shares because you need to hit your monthly target. Exactly 133 shares because that's the maximum size that keeps your potential loss within defined parameters. This formula forces one crucial shift. Your stop loss determines your position size, not your ego or monthly goals. Amateurs pick position size based on greed, then place stops wherever convenient. Professionals identify stops based on chart structure, then calculate position size to match their risk budget. Jesse Livermore discovered these truths through 4 complete boom-bust cycles. His legendary millions came not from massive initial bets, but from starting reasonable and pyramiding as the market confirmed his thesis. He would risk 2% to make 4%. When the position moved favorably and hit his first target, he'd add another position, but move his stop to break even on the entire position. Now he had larger exposure, but zero risk to original capital. If the trend continued, he'd add a third position using profits as risk capital. This is the professional's maxim: risk tiny, scale into strength, let time compound the edge. Notice the sequence. You don't start aggressive hoping to be proven right. You start defensive, then become aggressive only after the market proves you right. When you remove the artificial 60% monthly pressure, something magical happens to your trading psychology. You stop forcing trades that aren't there. You can look at a consolidation pattern and think, this setup is 70% formed, but it lacks confirmation, and walk away without guilt. You don't feel anxiety about holding cash. You understand that preservation trumps participation. You wait for confirmed breakouts from genuine pivotal points, not just any support or resistance, but price levels where the technical picture changes materially. You let the market come to you instead of chasing every move. You trade like a sniper, not a machine gunner. The amateur looks at 4% monthly returns and thinks too slow. He's trapped by linear thinking. The professional sees geometric growth. She understands that 4% monthly, compounded consistently over 5 years, turns $10,000 into approximately $82,000. That's not a typo. The mathematics of compounding at modest rates over time create wealth that feels impossible to the human brain because we think in straight lines, not exponential curves. Here's the comparison that should permanently change your perspective on speed. The sprinter targeting 60% monthly is usually broke by year 2, even if he's talented. His risk parameters guarantee eventual ruin. It's only a matter of when, not if. The grinder targeting 4-5% monthly, with strict risk control, compounds over 5 years into genuinely life-changing wealth. One approach feels fast, but leads nowhere. The other feels slow, but leads to financial independence. The difference is survival mathematics. The sprinter must be right most of the time, because his risk parameters leave no room for error. The grinder can be wrong 40% of the time, and still profit, because her losses are small and controlled while her winners compound. The sprinter needs perfect execution in an imperfect world. The grinder needs only consistent execution in a probabilistic world. Your starting account size doesn't matter. These principles scale perfectly. Whether you begin with $1,000 or $100,000, the mathematics remain identical. Risk 2% per trade. Limit total exposure to 6%. Stop trading if you hit 10% monthly drawdown. Calculate position size based on your stop loss, not your ambition. These aren't guidelines. They're the foundation every professional trader who survived more than 5 years. The market will always provide another opportunity, but only if you have capital left to deploy. Speed kills accounts. Patience builds fortunes. The choice is always yours, but the mathematics are never negotiable. In Chapter 4, we'll tackle the hardest part of this entire framework: how to psychologically embrace boring when your brain craves excitement, and why waiting, doing absolutely nothing with complete intention, is the most active and profitable position you can take in the markets. Here's the concept that separates professionals from everyone else. Doing nothing is sometimes the most profitable trade you'll make all month. That sounds wrong at first, almost offensive to your work ethic. You came to the market to trade, to act, to participate. You equate activity with progress. But in trading, as in war, unnecessary movement is how soldiers get killed. Livermore called it sitting tight. He understood that the big money was not in the buying or the selling, but in the waiting. Modern institutional traders soften this with phrases like waiting for your pitch. The amateur has a more honest label for it: torture. Because to the amateur, Silence on the tape feels like failure, like opportunity bleeding away with every tick he doesn't capture. When you adopt modest monthly targets, something remarkable happens to your relationship with time and pressure. You stop needing to trade. The desperation valve releases. You realize there are approximately 20 trading days in a month. You don't need 20 trades to hit a 5% target. You don't need 10. You need 3. Maybe 5 if the market is particularly generous with quality setups. The rest of the time, those other 15 days, you're watching, learning, stalking, letting bad setups reveal themselves without costing you capital. This is where most traders fail. Not because they can't identify good setups, not because they lack technical knowledge. They fail because they cannot tolerate the psychological discomfort of doing nothing while the market is open. The market becomes a slot machine. They need to pull the lever. They need the dopamine hit of action, even if that action destroys their account. Think like a sniper, not a machine gunner. This metaphor contains the entire philosophy of professional trading. A sniper spends 99% of his mission still, patient, observing. He studies the target. He calculates wind speed, distance, elevation. He waits for confirmed range, clear sight line, ideal atmospheric conditions. Then one bullet, one target, mission complete. He doesn't fire randomly hoping something connects. He fires once because he's prepared everything to ensure that single shot counts. The amateur trader is a machine gunner. He empties the magazine by Tuesday morning, spraying bullets in every direction. Every gap up becomes a target. Every momentum spike triggers the same reflex. Every social media tip with rocket emojis demands immediate action. He feels productive because he's clicking buttons. He mistakes activity for achievement. By Wednesday, he's reloading, confused why his account is smaller despite all his work. Here's a real example that crystallizes this principle. A professional trader I've studied took only 4 trades in January. 4 trades in 21 trading days. To the amateur, that sounds like laziness. To the professional, that's surgical precision. Each trade was a confirmed breakout from a genuine pivotal point, a price level where the technical picture changed materially, where volume confirmed institutional participation, where the risk-reward setup was at least 1, 2, or better. She won 3 of the 4 trades. Her single loss was cut immediately at her predefined stop, costing her 1.8% of her account. Her 3 winners averaged 2.5% each. Total monthly return, 5.8%. She was bored most days. She watched Netflix during market hours. She went to the gym at noon. She read books about trading instead of actively trading. She was also profitable, calm, and sleeping well at night. Compare this to an amateur operating in the same January market. He took 37 trades. 37. He chased every gap up, every momentum move, every Discord alert. He felt busy, active, engaged. He felt like a real trader because he was constantly in the market, constantly making decisions, constantly grinding. His win rate was 51%. 19 winners, 18 losers. On the surface, this looks acceptable. He won more than he lost. But here's the brutal mathematics. His average winner was 1.2% because he took profits quickly, afraid the market would reverse. His average loser was 3.1% because he held losers too long, hoping they'd recover. Despite winning 51% of his trades, his account shrank 7% that month. Same market, same opportunities, different activity level, opposite results. The professional who traded 4 times made money. The amateur who traded 37 times lost money. This isn't coincidence. This is the mathematics of selectivity versus activity. Here's the professional's paradox. Waiting isn't passive, it's active risk management. Every trade you don't take preserves capital. Every bad setup you ignore is a loss you avoid. When you pass on a questionable setup and watch it fail without you, you've just made money. Not literally, but practically. You kept capital that would have been destroyed. That capital is now available for the next confirmed setup. Think about this mathematically. If you avoid 5 trades this month that would each have cost you 2% of your account, that's 10% of your equity preserved simply by not acting. 10% preserved is mathematically identical to 10% earned. The amateur doesn't count these invisible gains. The professional does. Your brain will fight this discipline every single day. Here's why. When you set aggressive goals, your anterior cingulate cortex, responsible for goal-directed behavior, activates more strongly. When it activates intensely, it suppresses your prefrontal cortex, which handles rational decision-making and impulse control. Translation: the harder your goal, the dumber your decisions become. But modest goals keep your executive function intact. Your limbic system, the ancient part of your brain responsible for fear and desire, cannot distinguish between missing a trade and missing a meal when you were starving. Both trigger the same scarcity panic response. When you see a stock moving without you, your limbic system screams opportunity is escaping. Even though logically you know another opportunity will appear tomorrow, next week, next month, your brain will whisper lies. Slow is losing. Waiting is weakness. The move happening right now is the one you can't miss. Everyone else is making money except you. This voice has destroyed more trading accounts than bad strategy, poor risk management, or lack of knowledge ever could. This voice is your enemy, and it speaks in your own thoughts, which makes it almost impossible to recognize. Professional traders have learned to recognize this voice and ignore it. They understand that the discomfort of waiting is not a signal to act. It's a signal that their brain is functioning normally, and that normal brain function is incompatible with profitable trading. Here's the waiting protocol that replaces emotional impulse with systematic discipline. Step 1. Predefine your pivotal points before the market opens. Identify the specific price levels where you'll consider entry, genuine support and resistance zones where institutional money has historically reacted. Write these down. If the market doesn't reach these levels with proper confirmation, you don't trade. Period. No negotiation with the chart. Step 2. Demand confirmation before entry. Touching a resistance line isn't enough. You need volume expansion, clean breakout above resistance, and preferably a catalyst or broader market alignment. If the setup lacks confirmation, no entry. Your rule is binary: confirmed or not confirmed. Step 3. Treat no trade days as successful days. This requires a complete mental reframe. You're conditioned to measure success by action, trades taken, profits made, account growth. You must recondition yourself to measure success by capital preserved. Every day you don't lose money is a victory. Every week you avoid a catastrophic trade is a month closer to your long-term goals. Step 4. Track avoided losses using what I call the ghost journal. When you see a setup that looks tempting but breaks your rules, maybe it's extended, or lacks volume confirmation, write it down. Don't take it, but track what happens. A week later, review that trade. 80% of the time, it would have failed. When you see the bullet you dodged, you develop deep respect for the power of waiting. Once you internalize this protocol, the market changes character. Choppy days where you once saw missed opportunities now look like successfully avoided traps. Quiet consolidations where you used to feel restless now feel like setup periods, like the market inhaling before the exhale you're waiting for. Sideways weeks become your friend, because you know other traders are bleeding out on noise while you sit untouched, capital intact. The market is an infinite stream of opportunities. It will be here tomorrow. It will be here next year. It will always provide another opportunity. But it will only provide that opportunity if you have capital left to deploy. If you blow up your account chasing mediocre setups, the next perfect setup is irrelevant because you're not in the game anymore. Waiting is your weapon. It's how you defend against your own impulses. It's how you outlast the 90% of traders who blow up in their first year. It's how you ensure that when the genuine, high probability, technically perfect setup finally appears, you have the capital, the mental clarity, and the emotional discipline to strike with full conviction. The amateur looks at a professional's trading journal and sees boring. 4 trades per month. Long stretches of inactivity. Modest percentage gains. He thinks, I could never trade that slowly. What he doesn't see is the compound growth over 5 years, the absence of catastrophic drawdowns, the psychological peace that comes from never being overexposed, and the wealth that accumulates when you stop bleeding capital on bad trades. Professional trading done right often feels like watching paint dry, punctuated by brief moments of decisive action. If your trading day feels like a casino, you're doing it wrong. Amateurs seek stimulation. Professionals seek signal. Cash is a position, a valid, active stance that preserves your ability to act when the right moment arrives. In our final chapter, we'll reveal the advanced technique that occasionally does produce those 30%, 40%, even 60% monthly returns you've been chasing. But understand this going in, those exceptional months happen only as a byproduct of discipline, never as the primary objective. They're the reward for patience, not the goal of aggression. We'll explore pyramiding, the only safe way to turn small, disciplined entries into massive positions when the market proves you right. Now we close the loop. I told you not to chase 60% monthly returns because that desire destroys accounts. But that doesn't mean you can't achieve 60% in a month. The difference between financial suicide and sustainable wealth building is how you get there and when you allow it to happen. The amateur tries to hit 60% by betting big on day one. He calculates what position size would generate his target return, then enters with maximum conviction, risking 15-20% of his capital on a single idea. He's front-loading his risk, demanding that the market cooperate with his timeline. This approach occasionally works, which makes it infinitely more dangerous because those rare successes convince him the strategy is sound. The professional gets there by being right, sitting tight, and pyramiding. She enters small, waits for the market to confirm her thesis, then methodically adds to the position as the trend develops. Her exceptional months aren't planned, they're discovered. They emerge naturally from the mathematics of adding to winners while keeping original risk controlled. This is Jesse Livermore's most advanced technique, the one that built his legendary millions after he learned from his bankruptcies. When a trade moves in your favor, the market has confirmed your thesis. Price action and volume are telling you that institutions agree with your analysis. You're now playing with what professionals call house money, profits that didn't exist before the trade. This is the only time you're allowed to be aggressive, not at entry when you're guessing, but after confirmation, when you're responding to what the market is actually doing. Here's where most traders fail psychologically. The amateur takes profit the moment he sees green on his screen. A position moves 3% in his favor and terror strikes. What if it reverses? What if I lose this gain? So he sells immediately, banking small profits while telling himself he's being disciplined. Then he holds his losers, hoping they'll recover, because he can't stand the psychological pain of admitting he was wrong. He cuts his flowers and waters his weeds, the exact opposite of what creates wealth. The professional has rewired this destructive instinct. She understands that big moves rarely come from single entries. They come from adding to strength, from using unrealized gains to justify expanded exposure. When her position moves favorably, she doesn't look for the sell button. She looks for the buy button. The market just told her she was right. That's her signal to press the advantage. This requires overcoming one of your deepest psychological barriers, the fear of giving back open profits. You have to be willing to risk paper gains to capture exponentially larger real gains. You have to buy at higher prices than your original entry, which feels wrong to every fiber of your being. But you're not buying randomly at higher prices. You're buying because those higher prices prove demand is real. You're paying for confirmation. Here's the systematic pyramiding sequence that transforms modest trades into exceptional returns. Step 1. Enter with your standard 2% risk on the initial position. You've identified a confirmed breakout from a pivotal point. Volume is expanding. The technical picture meets every criterion in your playbook. Calculate your position size using our established formula, account size times 0.02, divided by the difference between entry and stop. You enter conservatively because you're testing the market's commitment to this move. Step 2. When the trade moves favorably and hits your first target, typically a 1-2 or 1-3 risk-reward ratio, add another position of equal size. The market has now proven your initial thesis was correct. This isn't hope anymore. This is confirmation. You're not doubling down on a losing position. You're scaling into a winning position that the market has validated. Step 3. Immediately move your stop loss on the entire combined position to break even or slightly above your original entry. This is the critical step that transforms pyramiding from gambling into systematic wealth building. You now have double your normal exposure, but your risk to original capital is zero. If the market reverses completely, you exit at break-even. You've lost time and opportunity cost, but no actual money. Step 4. If the trend continues and breaks through your second target, add a third position using profits as risk capital. You're now at triple normal exposure, 6% of your account deployed in this single trade. But here's the mathematical magic. You're still risking nothing of your original capital because your stop protects at least break even on the entire position. Step 5. As the position continues moving favorably, trail your stop using technical levels, previous resistance that's now support, moving averages, whatever your system dictates. You're now in pure profit maximization mode, trying to squeeze every possible dollar from this confirmed trend while ensuring you don't give back meaningful gains. Let me show you exactly how this works with precise mathematics. Your account is $25,000. You spot a stock breaking out from a consolidation at $50 with heavy volume. Your technical analysis suggests a stop at $48, a $2 per share risk. Your 2% account risk limit is $500. Position size equals $500 divided by $2, which is 250 shares. The stock moves to $54, hitting your first target. You add another 250 shares at $54. Your stop on all 500 shares moves to $50, break even on the first lot, $4 risk on the second lot. The profit potential on the first 250 shares helps finance the risk on the second 250 shares. If stopped out now, you break even despite having double normal exposure. The trend continues. The stock reaches $58. You add a final 250 shares. You now own 750 shares with an average cost of approximately $52.67. Your stop is at $51, locking in profit on the entire position. You have triple normal exposure, but zero risk to your original capital. The stock ultimately reaches $64 before showing exhaustion signals. You exit at $63.50. Your total gain is approximately $8,062 on a trade that began with only $500 at risk. That's a 32% account gain from a single trade that never exposed you to catastrophic loss. This is how professionals occasionally achieve those impossible monthly returns, not by chasing them, but by letting proper position management create them as a natural byproduct. The amateur looks at this sequence and thinks, why didn't she just buy 750 shares at $50 and make even more? Because if the trade had failed immediately, she would have lost $1,500 instead of $500. That's 6% of her account versus 2%. Experience 3 of those failures in a row, and you're down 18%, requiring a 22% gain just to recover. The mathematics of drawdown are unforgiving. The professional never exposes herself to that risk. This is the maxim you must internalize. Slow entry, fast profit accumulation. The amateur enters fast, hoping to accumulate profit fast, but usually accumulates losses fast instead. The professional enters slowly, testing the waters, then accumulates profit rapidly once the market confirms the trade is working. Here's your complete trading protocol, synthesizing everything we've covered across all 5 chapters. Start each month targeting 4-5% returns. This keeps your brain calm, your risk management intact, and your decision-making rational. You're not desperate. You're not forcing trades. You're waiting for quality setups that meet your criteria. Risk 2% per trade, maximum. This ensures you can survive 20 consecutive losses and retain 2/3 of your capital. The market will test your discipline. You will be wrong. Your survival depends on keeping those wrongs small and manageable. Wait for confirmed pivotal points only. Not every support level matters. Not every resistance line is significant. Wait for price levels where the technical picture changes materially, where volume confirms institutional participation, where every element of your setup checklist is satisfied. Cut losses immediately when stops are hit. No negotiation. No just a little more room. No hope that the position will recover. When price hits your predetermined stop, you exit immediately. The trade thesis has been invalidated. Preserve your capital and move on. Add to winners as trends develop. This is where exceptional returns originate, not from being right at entry, but from being right and then systematically pressing that advantage as the market confirms your thesis over time. Use the pyramiding sequence. Move stops to protect capital. Let mathematics work for you. Let time and compounding do the heavy lifting. You're not trying to outsmart the market. You're not predicting the future. You're managing risk on the downside while maximizing opportunity on the upside. The mathematics of this approach, executed consistently over years, create genuine wealth. The amateur looks at your 4% monthly target and laughs. He's aiming for 20% this week because he's special, different, destined for greatness. He's going to crack the code that has eluded everyone else. Then he blows up. Again. He loses 40% in a bad month and spends the next year trying to recover if he doesn't quit entirely. You're still here. You're compounding steadily. You have boring months where you make 3%. You have exceptional months where pyramiding produces 25%. Your average is 5-6%, which compounds over 5 years into genuinely life-changing wealth. You sleep well. You don't check positions obsessively. You trust your process because your process has been tested and proven by mathematics, not hope. The amateur trades for excitement and bragging rights. The professional trades for consistency and compound growth. The amateur wants to feel like a genius. The professional wants to feel like a business owner. The amateur measures success by monthly returns. The professional measures success by decades of survival and systematic wealth accumulation. Here's your final maxim. The distillation of everything we've explored together. Cut losses fast. Size positions small. Wait for confirmation. Own your process. Cut losses fast means no hope, no prayer, no second guessing your predetermined stops. When you're wrong, admit it immediately, and preserve your capital for the next opportunity. Size positions small means 2% risk per trade maximum, regardless of how certain you feel about any individual setup. Wait for confirmation means patience is your ultimate weapon. Let questionable setups reveal themselves as traps without costing you money. Own your process means you've internalized these principles. They're not rules you follow reluctantly. They're part of your trading identity now. If you truly understand why slow beats fast, why 60% monthly as a goal destroys accounts, while 60% monthly as an occasional byproduct builds wealth, then you're ready for the advanced lessons ahead. The next video will teach you how to identify genuine pivotal points, the specific price levels where institutions act, where technical patterns carry real meaning, where the risk-reward mathematics justify deploying your capital. But remember this, everything you've learned here becomes worthless if you don't implement it with absolute discipline. You can study trading psychology and risk management forever, but if you open your platform tomorrow and risk 8% on an unconfirmed setup because it feels different this time, none of this knowledge mattered. Stay disciplined. Trust the process. Build wealth that lasts decades, not days.